You're watching Stockwatch this week. I'm Ntauleng Lechela, and joining me to unpack your stock-related questions today, Chantal Marx from FNB Wealth and Investments and Devin Shutte from the Robey Group. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Chantal, Devin, thanks so much for joining me this afternoon. So trade has been quite choppy this week. I feel like it's been choppy for most part of the year. But one thing that really spooked markets this week was those recession fears. Chantal, I guess those fears warranted, considering that Trump has followed through with some of those threats, right?
Yes, absolutely. So I think when he first started talking about tariffs, a lot of investors and economists were saying, oh, no, man, it's a negotiating tactic, particularly when he delayed the implementation of tariffs on Mexico and Mexico and Canada, rather. But he's delivered on some of these promises. And even though it came a month late, we did have those tariffs implemented against Mexico and China. And that resulted in investors and economists saying, well, wait a minute, if maybe he really means what he is saying. And now every time he says something, it's actually believed by the market. And that's why you are getting this volatility, the uncertainty, and actually a full-blown market correction in the US as of last night.
And I mean, I think the NASDAQ at some point this week was down 4%. Devin, what have you made of markets action over the past week?
Yeah, look, I mean, it's been a really tricky year, hasn't it? We're in correct territory, as Chantal said, on the S&P. I think the NASDAQ is in 20% from its high. So those are really significant moves. And I think you're exactly right, is that the market is now coming to terms with the possibility that this Trump administration will accept short-term pain in the market for their America First goals. So to my mind, what that does is kind of removes the Trump put that we've been kind of used to, that, his administration doesn't like a underperforming stock market. He said he's not even looking at the markets at the moment. And this really fed a lot of uncertainty and nervousness into the market. And I think a bigger theme that's maybe investors are starting to question is this American exceptionalism that we came into the markets in the beginning of the year kind of believing that's really shown quite a few cracks.
Yeah.
And the numbers are actually quite stark. I was just looking at year-to-date performance. S&P and NASDAQ are down between 6 and 10%. But then you've got something like the Euro stocks up 9%, JSE up about 4%, and the Chinese market also positive. So you're starting to see a very big divergence from what we got used to the last couple of years.
It's very interesting to also see some of the economic data, because if you think of the last US retail sales print, we got quite downbeat, consumer confidence as well, downbeat. And as you mentioned, numbers out from local equities positive, numbers out from European equities really positive. And you also touched on the uncertainty we've been seeing. And with uncertainty comes investors hiding or trying to find safety. And we've seen the gold price really soaring on the back of this. I think yesterday it hit around $3,000. It has retreated back under that $3,000 mark. And we have a question on gold, which reads, with the price action we've been seeing, do you see more strength in gold shares despite their strong run to date? Chantal, I'll start off with you there.
Yes, so I mean, I generally regard gold miners to be a late cycle play. So what I mean by that is when the gold price is high and it doesn't have much more room for improvement just because it's very high, and the $3,000 level, I think, is also a very important technical kind of resistance level for gold. When gold is kind of supported at these levels, you're not necessarily going to make a lot of money buying a gold ETF or buying Krugerrand, but you are going to see gold miners print cash at these levels, because even though their costs have been increasing, it's still a long way away. Their cost of production is still a long way away from the actual money that they're getting for the gold that they're selling. So profit margins are very big at the moment, and I think that they'll remain quite large as long as the gold price is at these levels. So which of the gold miners would I be buying right now? I'd probably stay away from Harmony Gold. It's been the outperformer during the current gold bull run that I'll trace back to the Ukraine, the Russian invasion of Ukraine. And we've seen some safety issues creep in there more recently, which means they're probably not going to take as much gold out of the ground as they would like. One of the laggards has been Pan-African Resources. They forward sold some of their gold, and those forward contracts were at lower prices than the prevailing gold price. Those contracts came to an end at the end of February. So they are now actually fully benefiting from this very high gold price. They're also the lowest cost producer in the South African gold mining space. So I think you need to be quite selective about your exposure, but I think that gold miners make sense to me in terms of where we are in the cycle right now.
Devin, do you share the same sentiments, or are you looking at perhaps the gold fields or an Anglo Gold?
Look, I mean, I think gold's definitely having its time in the sun. It has for a while, and makes complete sense. You know, it's a hedge for portfolio volatility. And, you know, just in our initial discussion, it doesn't look like that's going away anytime soon. So, yes, I am quite constructive on them. I mean, you know, you do have to have the stomach for the volatility that comes with holding a gold miner. And, yeah, I mean, I like Chantal's recommendation of Pan. I do also think Anglo Gold Ashanti has some features that investors are worth looking at. But I think overall we're going to be in this environment for a while, where it's kind of a surge in volatility, and then the gold price will provide some cushion to that, and then maybe some more normalization. And to your original point about the data, I actually think the economic data, the hard data coming out of the US, while slowing down, is still looking okay. But you hit the nail on the head when you said kind of sentiment indicators are starting to soften, and it's probably a matter of time before those sentiment indicators feed into the hard data. So yeah, lots for us to consider as investors at the moment.
Lots to chew on, and we're also still really waiting to see the impact of those tariffs on inflation as well. So I guess a wait and see game for many traders. Let's move over to the banking sector, and I'll stick with you, Devin. A viewer is asking for your analysis on FNB, so I guess that would be FirstRand.
Yes, that's right. So some results out quite recently. Again, a high-quality bank in the local space, still keeping that return on equity north of 20%, which is a really important profitability metrics there. You know, nice increase in their dividend per share, and I think really executing well. So, you know, if you look broader at our banking sector, I think we've really got some investors are spoiled for choice there. We had Standard Bank come out with their results as well this week. And I think generally it's an environment where they will still continue to do well. Yes, there's a lot of competition coming in, particularly from digital banks, you know, none of those legacy IT systems. But the client bases and the lending books in these large banks are just enormous, and they're really doing well to generate that bottom line growth.
And let's just stick with those numbers, those banking numbers in particular. We are seeing most of the lenders booking in lower impairment charges as well. We are starting to see some loan growth, especially on the corporate side as well. What I found interesting in those numbers is that we saw FirstRand, Nedbank, and Absa growing earnings by around 10%, whereas Standard Bank yesterday had earnings growth of 4%, but Standard Bank's ROE still sitting at, or rather still quite higher than its peers at around 18.5%. Chantal, what has your reading been around those banking numbers in particular?
Well, I think that the banking numbers have been quite solid, and they've been quite varied, because each of these banks actually have a different, I would say, exposure. It's not exactly the same. So I think where some of the banks have done very well on the trading side and on the insurance side and kind of the non-interest income side, other banks have actually seen pretty decent improvements on the lending front. So overall, I think I share Devin's sentiment that we are spoiled for choice from a South African banking perspective, and these numbers actually just showed that, and the outlook statements, I think, were pretty upbeat.
And you know what I found really interesting was ABSA's outlook on SA growth, where they expect, I think, over 2% growth for the economy, way lower than a lot of estimates. I don't know, am I just being a pessimist when it comes to SA growth here, Chantal?
So I think that's, again, it's quite varied at the moment, because there are so many kind of different moving parts.
Okay.
So a lot of economists have started paring back their expectations on growth. but a lot of them still remain pretty upbeat because of the fact that we have more reliable electricity supply. Consumer confidence is still looking okay, despite some of the external issues that we're facing at the moment. And the interest rate environment and inflation environment, I think, is conducive to economic growth. The trick, I guess, will be whether or not the external issues, particularly South Africa's positioning from a geopolitical perspective, is going to have an impact on confidence, be that in businesses or on the consumer side. And I think that that's where some of the economists have become a little bit more conservative in terms of their near-term outlook in particular.
All right, let's shift focus to the beauty industry. Devin, what are your views on Estee Lauder?
Look, it's not one I follow too closely, but what you've got to remember about this business is it really taps into that kind of aspirational consumer discretionary spend. And yeah, that hasn't necessarily been the easiest place to be at the moment. So I think it's one we're still watching closely for, where their operations are outside of the US. If those really manage to start getting traction, but it's really at a tough old time. I mean, the stock's down, it's pretty much halved in the last year. And yeah, I think the kind of global macro environment with tariffs and all that are definitely not conducive to a company like this doing well. So yeah, I'm not particularly positive at this stage. I think it's going to need a lot of economic tailwinds that, given our uncertainty backdrop that we spoke about, I'm just not seeing yet.
And Chantal, your views around Estee Lauder, I think of that company also struggling because of the downbeat consumption we've been seeing in China as well. But I mean, we know that government is trying to stimulate growth, is trying to stimulate demand on that front. Does that make you a bit more positive on the counter?
So what's been very interesting is that it's been a story of divergent fortunes. So even though you have seen the likes of an Estee Lauder come under a lot of pressure, other companies have actually continued to take market share, and L'Oreal is one of them. So L'Oreal is a stock that I really, really like. And if you look at the beauty market growth generally, it's continued to be positive at between 4.5% and 5%. But, well, it's expected to be positive this year, between 4.5% and 5% growth. And L'Oreal will benefit from that. Estee also benefit from that, but they also have a self-help narrative that needs to play out. They've been under a lot of pressure from a sales perspective, lost a lot of market share. So I'm a little bit more skeptical around Estee Lauder's forecast.
All right. The question here reads, is SRI a good investment over the medium term as it has UK supermarkets in its portfolio?
Yeah, so it's such an interesting differentiator and kind of diversifier from a property exposure perspective. So I think actually from a portfolio diversification perspective, this one is very interesting. So it's a property company, it's a REIT. That means that they have properties that they rent out. And these guys specifically rent out the kind of large format supermarket properties to supermarket operators like Tesco and Sainsbury in the UK and Carrefour in France. So the income stream is actually quite defensive because these guys will have very long kind of lease periods. It'll be negotiated well in advance. There'll be inflation related rental increases embedded in those contracts. And the companies themselves that are going into these rental agreements also quite defensive because it's mainly food retailers. So I think that it's a really nice defensive stock. The yield isn't as attractive as you would find in the local property space, but I think your certainty of cash flows is a little bit better.
And looking at those property counters, we've had numbers out from them, out from a few rather of them this week. Attack, Growth Point, and High Prop out with numbers. Those counters really making a comeback on the back of that lower interest rate environment. That really working in their favor, right, Devin?
Yeah, I think so. I mean, you've got to remember where they came from. Maybe it was 2 years ago where they just nobody wanted to touch this sector at all after being a high-flying sector for years and years and on end. So yes, definitely the softening of interest rates is helping. You're seeing those distributable earnings almost across the board pick up. you're seeing those occupancies increase, kind of post-COVID and the work from home trend there. So I think, and, you're also seeing increased foot traffic in the retail space. So, whatever sector you're in, I think it's been more positive. I don't think it's necessarily been the perfect environment. These property companies, they need a kind of loose monetary policy environment, but they also need underlying economic growth to really start to deliver. And I'm afraid that's probably been the missing piece, definitely locally. But even offshore, it's been tough going.
Chantal, what have you made of those property counters that have a lot of exposure to the office property subsector? I mean, that subsector has really been struggling. But I think when I spoke to the CEO of Attack, she said that they are starting to see some growth on that front. Would you, dabble or dip into that subsector in particular, or would you rather stay with property counters that I guess have more retail exposure, more industrial logistics exposure?
Yeah, I mean, so my first preference would be for something that's reasonably priced in the logistics space, because I think we still have a shortage of supply there. And you can see from these companies that actually specialize in logistics, like Fortress and Equitas, they're basically fully let, right? And any developmental or any kind of speculative development that they put out there is kind of let as soon as they open the park gates. So that would be first prize. Unfortunately, it's a little bit more expensive to be exposed to those companies, but the growth, I think, is certainly there. In retail, that would probably be kind of the second space that I would want to be in. I think a lot of these companies have cleaned up their retail portfolios quite nicely. They've divested from some of the properties that didn't make sense to them. And the big guys that have exposure to some of these flagship retail assets, and then the smaller guys that have access to these strip malls, kind of in rural and non-urban areas, all of them have been performing well because they're actually addressing a need of the consumer. So I think that they'll continue to do well in that regard. With office, it is so complicated because we were completely oversupplied with office even prior to COVID-19. Instead of revamping a B and C grade office space, a lot of the big players just sold them off and developed premium and A grade offices. So the office supply is just in such abundance. I think you'll continue to see vacancies very, very high unless you start seeing a ramping up of redevelopment. But what the big guys will do is they'll continue to sell the stuff that they cannot let out. So their vacancy rates will continue to look a little bit better. But it's not a space where I want to be in, I think, for the next 20 years. I think we've got enough office supply for 20 years.
Yeah, and I think, what's this, Growth Point disposed of about 12 office properties over the past half-year period. Just sticking with the niche players in the property sector, one I find quite interesting is storage. Devin, is that one you look at?
Not closely,
Okay.
but I mean, I think what you've got there is similar to the trend Chantal was referencing. Is you've got that kind of more reliable annuity income coming in there. You've got very little vacancies in terms of those storage units there. So from a kind of evaluation perspective, it's easy or you've got clear line of sight to those cash flows. So yeah, that's been an interesting one. And it's one we've kind of considered, but haven't taken the jump yet.
Let's move over to the retail sector. A question here reads, Mr. Price is over 20% down over the past 3 months. Why? Similarly with Pepkor, at current levels, are these stocks a good entry point? Devin, I'll give that one to you.
Yeah, sure. So, I mean, Mr. Price has the habit of kind of running ahead of itself. It's a great business. It's really done well to keep reforming itself as the consumer demand changes. Occasionally they get those things wrong, but generally they do well. They've made some really meaningful acquisitions of late. Strong cash generation, predominantly a cash business as well. And so what you've seen is them gaining market share. So, in terms of the price action, sometimes the market kind of gets a little bit excited and it pulls back a bit. And my sense is that's what you're seeing at the moment. But it's a company we like. It's a company that continues to execute consistently, do well for shareholders, sits in a net cash position. And so, yeah, I think probably one that we would be looking at on weakness rather than, just thinking there might be a problem there.
What about Pepco, Chantal? What are your views around Pepco?
Yeah, I mean, so Pepco's become really interesting over the last few years. I'd probably say the last year. They have a big fintech business where they were kind of distributing microloans, but they've actually started utilizing that fintech business and cross-selling into their existing store footprint, and not by giving micro loans, but actually by giving store credit. And I think that could be really, really interesting for Pepco. I think it's going to spur growth in Ackermans and Pep. I think they'll manage it very conservatively, so I won't be necessarily super worried about an increase in bad debts or anything like that. And then another interesting thing has been their foray into home. I think Pep Home is just such a great product, and I think that they'll continue to grow quite nicely there. They have a few bits and pieces in that business that I don't necessarily love. Hi-Fi Corp, incredible connection, I think they can do without, but it does diversify their earnings stream somewhat. And then you've got the Brazilian business that they haven't said much about this so far this year. That would be my only worry. I think they have the ability to execute long term. It's a very exciting growth market, but the fact that they haven't said anything really substantial about how things are going there is worrying me a little bit.
And another retailer I've been finding quite interesting, a clothing retailer, is TFG, and what they've been doing with Bash, and you know how they've been competing online with the likes of Superbalist. What's your views around TFG and what have they been doing? Devin, let's go.
Yeah, so I think that online channel is working for them. I think it's something that they had to do. The competition was really becoming pretty intense, and I think they had to decide where they competed against kind of the Chinese competition, which is really the low cost manufacturing side of things. So I think that they're seeing particularly good growth there off that e-commerce platform. I think last reporting period, if I remember, it was around 40% or so. So that was pretty impressive. Credit sales still continue to drive some of the market there, but yeah, overall they're managing those bad debts on the credit side, so I'm happy with that. They also strong cash generation there. They are struggling a little bit with margin compression, but I think in probably a difficult environment, where they really have to fight for their space, I think they're doing a decent job.
All right, before I get to your stock picks, Chantal, this one is for you. It reads, what are your views on Palantir now that it's come down from its highs, and when will the FNB ETN Palantir be available? Very quickly there.
So I'll start with the FNB ETN, the Palantir ETN. That is expected to launch in the next week or two. So I think you'll be able to buy it on the JSE pretty soon. We did put out a really comprehensive note, I think, on January on our investment insights portal on FNB as well, if you want to read a little bit more about the stock. It is super interesting. So I really like Palantir from a longer term perspective, but my worry a few months ago was that it was just exceptionally expensive. The share price had run well ahead of any sort of fair value metric. And I had a look at it earlier this morning, and I see that it's actually now about 20% below the consensus sell side price. And it's there for the first time in a very, very long time. So it still looks expensive, but I think the addressable market is quite significant. A lot of guys view it as a defense stock. I think that the growth for this company is actually outside of defense. I think it's kind of done in terms of contracts what it can with the US, and there'll be limited scope for defense contracts elsewhere, just given the US's positioning against the rest of the world right now. But in the commercial space, I think Palantir can do a lot in terms of improving efficiencies and the way that companies operate. So yeah, I mean, I would start to kind of nibble at Palantir now. But I think that given where we are from a market volatility perspective and around concerns in the US and concerns around US AI stocks, there could be further opportunities in the weeks to come. So I'll start nibbling at it, but probably average down as the price declines.
All right, so you're nibbling on Palantir, but that's not your stock pick. We have about 30 seconds for you and Devin. So I'll start off with you, Chantal. What is your stock pick?
It's so easy. We spoke about it. It's TFG.
Okay.
So I think the retailers have been under unnecessary pressure. TFG looks the cheapest by far. It's trading well below its average forward PE rating over time. I can see a clear growth trajectory for the company. I'm very comfortable with that being my pick this week and keeping it at that. I think that's 10 seconds.
Devin, what are you hanging your hat on today?
Yeah, I'm going the China Internet ETF, KWEB. It's one we've chatted about before. And I'm just seeing increasing evidence that global investors are warming to China with some cracks in that US exceptionalism. Valuations are incredibly cheap. They're doing some amazing things in the AI space and others. And I think it's a neglected part of the market that's looking increasingly interesting.
So a bit on China as well as the SA retail sector. Thanks to our guests, Chantal Marx from FNB Wealth and Investments and Devin Shutte from the Robey Group. Remember that Stockwatch pre-records on a Monday and Wednesday at 1 p.m. and is live at 6:30 p.m. on Tuesday and Thursday, while Stockwatch this week is live at 12:30 p.m. on Fridays. Keep that in mind and keep your questions coming through. For now, that's all from Stockwatch this week, but do stay tuned for lots more coming up right on Business Day TV.